Big tech giving back some of yesterday's gains. You're looking at a drop of just about 0.5% here for the NASDAQ 100 at the open. The moves this morning coming off a record-setting day for the market. The S&P 500 still hovering not too far from yesterday's record level, just trading just below the flat line here in early trading. We want to bring in Ed Clissold. He is Ned Davis Research Group's chief U.S. strategist. Ed, it's great to have you here. So we saw another move to the upside yesterday with the S&P closing at another all-time high. Some give back in early trading action today, but take a step back. How does this set us up here to the action that we will likely see play out in the coming weeks?
Yeah, it's an ongoing bull market. You think about the concern right now is the economy too strong for the Fed to cut rates? That's actually a pretty good place to be. And we think the Fed will cut maybe a couple of times this year, but in fact, the market has done better when the Fed has cut slowly, up about 24% in the next year. That's not a forecast, that's just the average historically, versus up only 5% when the Fed has cut quickly 5 or more times in a year. So this is actually a pretty good place to be. Now, short term, we've come a long way. There's lots of optimism. If there's a breather, a pullback, that may actually be a healthy thing for the long term. But big picture, things are in pretty good shape.
So Ed, what's the catalyst here? Why did we see so much green after that hotter than expected inflation print, and then we're seeing this pullback today? What is the reason?
Well, I think that the initial reaction was, uh-oh, this is a repeat of last month, where it's a hotter expected inflation number. But the market really prices in the same news the same way. We've already gone through that discounting of moving out. A month ago, the market was looking for 5, 6, maybe even 7 rate cuts coming up, and now the market's pricing in 3. Maybe that's a little bit too much, but the market's moved to where the Fed has told it wanted to be the whole time, and so given the fact we've come a long way, there's lots of optimism in the market right here. Take a breather wouldn't be too surprising.
How would you then position at this point, if we're going to see a bit of a breather here in the markets, what adjustments should investors then be making to their portfolio because of that?
Sure. If you're a short-term trader, you maybe consider, if you don't have a lot of exposure to what we call the shut sectors, that's staples, healthcare, utilities, and telecom. At this point in the cycle, particularly during election years, during the second quarter, they tend to outperform. Again, that's a shorter-term perspective. Longer term, still stay cyclical. But that's a way to maybe get into some areas that have underperformed over the past several months, and even going all the way back to the bull market that started in 2022. It's been historically weak for those areas. So if there is going to be a little bit of rotation defensively, if the market takes a breather, those are the areas we would focus on.
Ed, you mentioned the election year, and I'm curious about your take on how the election year could interplay with the Fed's moves. We have Stephen Stanley with a call for 50 bips of cuts this year after the election, so meaning after November there. To what extent does the Fed sort of have to wait until they know who the president is and how that will impact fiscal policy to be able to move forward on monetary policy?
Well, I think in terms of before the election, if anything, it would actually give the Fed a reason to go ahead and do one cut, maybe in June, versus waiting a little bit longer. Because once you get into the throes of the general election, that the Fed, above all, does not want to be viewed as being political, even though historically, occasionally they have been. They don't want to be viewed that way. So maybe that they would actually get started. And then afterwards, the Fed has been pretty clear that they are not trying to direct fiscal policy, but they are going to have to react to it. And that's part of the reason I think they were so aggressive in hiking last year. We had this accidental fiscal stimulus with a massive $140 billion increase in Social Security spending just from cost of living adjustments last year. So those sort of things will impact the Fed after the election. But before it may actually mean the Fed goes ahead and starts the easing cycle so they don't appear to be favoring one candidate over the other.